The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Conditions Hour. My pleasure to be here Monday through Friday. Actually, this Friday, tomorrow I will not be here. But normally Monday through Friday, 11 o'clock till 11 o'clock till noon. And I'd like to take your calls at 877-927-6648. Be my pleasure. Great few hours here with John and Tom. We got programming all the way through, especially being a Thursday today. You got Larry after me, Larry Pesavento. You've got Daryl Martin. You've got Dave White. You've got Tom O'Brien. And then you've got Andy Heck. So just great shows. All right, let's move on. We've got the Dow up 191 at 17,540. I'll discuss it all because this is a really, really important phase in the market. The S&P is up 21 at 2,034. Comp index is up 57 at 4701. You've got gold about unchanged at 1194. Silver, same thing. Silver is up a tad, up 7 cents at 1593. You got bonds down almost a point and a half. This is going to be really interesting. You remember I was looking for the TLT. I don't know if I even got to discuss it yesterday. I was looking for the TLT to go to 127.69 to make leg D's in the daily, the weekly, and the monthly in the Chapman Wave methodology. Most importantly, what I was expecting is that that the 120-minute chart would make a D or an E, and that we would get a turnaround. The big question: what should we short the TLT? Should we go to the TBT? You know what? There's so many other things going on. I decided, just like when we got the buy signal on the TLT originally, I didn't do it as a trade for my subscribers. Probably should have. I'm not sure that this is actually a trade here, other than pulling back somewhat. Look at this chart. Let me just show you right here. This is the triple yield chart of the 30-year. The white is the 30-year TYX, 30-year T-bond yield. The yellow or goldy color is the T-note, 10-year T-note, TNX. And the 5-year is the cyan, light blue color, FVX. The 5-year T-note. And look what's happened. The T-note 5 years just held very nicely within that kind of rectangle formation. The 10-year has dropped some, although it's bouncing as we speak. And this is going to be very important in terms of chart patterns, because what we've seen before is when you've had a significant decline in the 30-year, very often there is a little, not very often, often enough, there is like an H that goes to an M-shaped pattern. How you come out of that M-shaped pattern is really important. So the chances are that we've got to make a big deal about 2677. There's 2.677 in the TYX, the 30-year T-note yield. And, of course, I've already forgotten the number. What did I say, 2677? And the most recent low just a few days ago is 2687, 10 cents higher. So this is going to be very important, number one. Number two is I still think we're talking trading range for yields for a while. And that's what I've been saying for quite some time. I say between the high of 31.3 to 30, maybe 32 on the upside. And on the downside, I expected that 28 would be, 30 would be, between 30 and 29 would be a containment area. And if it went lower, then we could actually retest the lows. So now we're in that situation. Out of this can come a very sharp move to the upside or a breakdown. So, in fact, at this particular point, you're getting to a phase that says you could continue sideways, but a break of either one of these key parameters, that's on the upside, the arch formation made the high of the week of the 7th of November, 31.33, a push over there. That says something else is going on, and a decisive push under 26.77 says be careful. this is the Japanization of our bond yields continuing. In other words, going to the zero level. Now let's just go back to our story here. So now what we've got is that the E-minis were up huge. They were up. Yesterday they were up huge. Today they were also up huge, up at 2041.25. They're trading right now 12 below at 2028, up 20, still very strong. You see this 120-minute chart? You see this cup formation? You see the left side to the right side? Price time match so far, it has not gone to 2049.50. It's stalled. So we're watching this. I'm thinking, there's a question in the den. What about the VIX? Well, I said to my subscribers in my opening call, this is number on my 15, 16 bullet points. Today there were just 14. I said we're going to be covering, if we haven't already covered the short positions, we're remaining with the long position. That long position is up over 20% since we got it just a week ago. But most importantly, and we did add another long position. I'm not even sure how it's doing. I know we did get it, but I'm not sure exactly where it is right now. I'm trying to find it. I think it's up about a point, maybe a point or two. Okay. Now what's most important is that the question about the VIX, I said this is number 12 on the list of my Traders Corner. I said well, that would be the VIX position that we would trade. We did not get it yesterday. We just missed it, and every day is a brand new. My buy doesn't hang over to the next day because they're completely different conditions. So what I said was, did not get it yesterday. We will wait, even though risk-reward says a nibble here might work. Best to stay away for now. I just didn't want... I didn't want that risk, and now I'm going to explain to you what's going on. Let me just go to the dollar. See, the dollar rallied very strongly, gone almost back to where it was. The dollar index is in leg A, B, C, D, E, F. Might have recycled. I'm calling this G/B for now in the for now in the 120-minute chart. But look at this. So that's very good action on the dollar's part. USD JPY, the dollar Japanese yen, has been moving synchronously with the dollar. And look what happened. It's bounced. It's not even close to its previous high of 1.21838 made on the 5th of December, 8th of December. But you've got the same pattern. It's gone to a peak D in the 120-minute chart, almost at the previous left side high of 119.55, trading now at 118.69, up 0.049. And it looks like it's starting to struggle a little bit. There's a divergence between the price and the technicals. Most importantly, if the USD JPY spirals into the 120s. If it starts to trade in the 120s, I'd have to be very impressed with that, because that would probably say that the dollar is breaking out to new recovery highs. Let me just move this away in the weekly chart. And is extending, if it's by tomorrow at 4 o'clock, it will extend leg D in the technicals of the weekly chart, which still look outstanding. So that takes me to something else. Let me just show you the TLT, because this is the potpourri that I was trying to put together for my subscribers to my opening call. And one of the reasons why we were shorting quite heavily up until this morning, and I wanted to step aside today and see what we can do. We've got 120, let me show you this. It's just an unbelievably beautiful demonstration of the Chapman wave technique. You made a spiral sometime, it was on the 15th, was it? The 15th of October. The TLT, which is the Lehman 20-year T-bond fund, spiraled to trust. It went to, on the 15th, it went to 127.68. Closed decisively lower, and then just kept going down steadily until it hit 118.21, and that low was made on the 3rd of November. Then what happened is it started a brand new move, and that brand new move was very interesting. Why? Because that brand new move said, I'm moving up, and if I'm able to get even into the wick, but especially I said into about the 124-ish area, the moment I do that, there's a real good chance I'm going to test the high of the wick of that candle of the 15th of October, and I might break to a new high, and if I do that, it'll be leg D. Within that, we had a beautiful called the Chapman wave, overlapping wave. I should have got my CD book already here to show you these different patterns. And look what happened. You got a brand new sub buy mode, or what I call an inside buy mode in the Chapman wave, that went to a peak D from that 118.21 low in the TLT. Went to 122.81, and then the moment it went to 122.82, it started a move that said, I'm now in leg D. I call it gray D because it's under the sharp sharp plunge off the precipice of the Grand Canyon right there. A lot of effort to get back. And what happened is it slowly moved higher with no new legs to the no new legs other than D all the way until yesterday, 2 days ago, it spiraled to 127.72 to be able to break the 127.68 high. And that gave you an overlapping of D. And what does that say? When you get to D after an overlapping wave, you might be able to go to E, but usually it's D. Be careful because you're going to pull back into the cup from the lip high on the left side. Means you're going to go under 127.68. So now we're under the 9-period moving average right here, which is at about 124.93, somewhere around there, 124.94. Right there. And it's saying that the technicals are still pretty darn good. So that's the reason why I'm saying that I don't think bonds are, now they're digesting, but I don't think they're going to break down just yet. They could pull back, and they could pull back all the way to the 9-period moving average and the weekly to 122, 121, that area. But it looks to me like a big rectangle formation. And that coincides with what I was looking at in the yields when I was showing you this particular pattern right here. So now let's go on. And now this is what I'm going to talk about. In the daily chart, this is what I show my subscribers every day, and we go into great detail every single day on this based on the Chapman wave methodology. There's a pattern that I call the falling axe, and that says that a close above this dashed line is the start of a breakout, but it's not good enough. It means that every test has to hold a significant support level. In this case, it's the 200-period exponential moving average of 17,464. And we're trading now at 17,564. That's 100 points higher. Will we give back 100 points by the end of the day? Well, let's have a look at some of the key factors. What I was talking about before, why I thought that there was a chance that on Wednesday, Tuesday to Wednesday, we could start to see a digestive phase in the market and a bounce in maybe the crude oil, maybe the TLT pulls back, maybe the VIX stops its rally, maybe we've got all these things coming together where money flows out of bonds back into stocks. Now let's see if that's going to hold water for more than just 2 days. 700 points in the Dow, just about. That's really amazing. 2 days. So now let's look at this. If the money comes out of bonds, it would imply that bonds would be breaking. The TLT would fill the gap underneath 122.96. And when it does that, the stochastic should probably drop to 83%. But if it goes under 80% and the MACD cross is negative, that will say money will flow back into stocks. So I'll continue this theme as soon as we get back.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Check out the new look of Tiger TV. Now you can see all hosts, charts, and computer screens live in high definition. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Thinkorswim, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV. Now, crystal clear in high definition, 24 hours a day, 7 days a week. If you haven't seen the new look of Tiger TV, then visit TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. We're back. So we've got a couple of things that I wanted to talk about here. We've got a nice pop-up in aluminum, X, USX, etc. But most importantly, let me go back to the story that I was telling about the interpretation, my interpretation of what's going on here. The monthly chart, I don't even want to talk about until we wrap up on the 31st of December. Other than to say that right at this particular point, we have once again held beautifully on the 17,084, which is the 9-period exponential moving average. 9-period has been just an unbelievably beautiful. It's like a magic carpet on the upside, a magic staircase. So I've been watching that very closely, and the technicals are suggesting that we're getting very overbought, but overbought can remain overbought. In other words, I don't have a sell signal yet. There's a very different thing that's happening now in the weekly chart, in that yesterday morning before the open, the price was decisively under the 9-period exponential moving average. Let me make this a little, let me just look to see. Yes, I'm going to make this a little bigger so that we're talking apples to apples. You can see exactly what I'm talking about. I'm talking about this chart right here. I discussed this technique that I use, the Chapman Wave Inside Track, as a repellent zone. I got a down arrow here. Why? Because the price decisively closed under the 9-period exponential moving average. The MACD deflected lower. The stochastic went down. But look what happened. Stochastic gave a positive divergence. And because of it, we saw a massive move, almost a one-to-one, as if it was a fulcrum line right at 17,350 on the Dow. We went down to 15,855, and then we spiraled up to the high recently of 17,991. Funnily enough, it's only 600 points above the previous high. But look what happens. Now, I don't want to discuss this now. I would do it on Technical Friday, but suffice it to say that my question has been for years, decades, in fact, how on earth does the price know, especially when it's a composite made up of many, in this case 30 stocks, but S&P did the same thing. The SPX.X, look, this is exactly the same thing. Look at that beautiful up channel. How does the price know to remain within a containment area when the containment area isn't horizontal? In other words, if someone remembered, oh my God, 1991, or that what was it, 1530s or 1550s on the S&P, those were major numbers that you had to remember because there were big turns in the market. How do you remember stuff like that if it is a diagonal line and the price is moving up or the price is moving down? Because those numbers are going to fluctuate. It's not going to be 1991 because in 8 weeks' time, it'll be X%, whatever the gradient is, higher or lower. So here we get to the story, the real story. As far as I'm concerned, price movement is merely a fixed point of human emotion. Even though we've got more and more computers doing work these days, we haven't yet gotten to the point where it negates everything. I read a very interesting comment recently in Stocks and Commodities magazine where the person said, now that we're getting, will the Russian, why am I forgetting the name right now? Kondratiev. Will the Kondratiev theory not work out because of automated trading? And my theory is, forget it. Human nature is always going to intervene and do the wrong thing at the wrong time. So what I'm looking at here is this is a chart of human motion, and what the human motion says, we can go up, but there's a certain point we get a little nervous, and it pulls back. But if the overall tide is moving higher, then we will be making higher highs and higher lows. That's why the definition of a bull market, higher highs and higher lows. Bear in mind, it doesn't matter whether it's a 1-minute chart or whether it's a quarterly or a yearly chart, higher highs and higher lows. Incidentally, someone sent me a note to say in their quarterly work we've made we're in D from the very long-term outlook in the Dow, a long-term chart. So now, this is what we're looking at. Human emotion gets very, very nervous at that point or overly excited. You spike up and then you get repelled. But it comes down. But because it's a rising trend, it means that you go to higher highs and higher lows. Just to make it as simple as possible. If you want to do it mathematically, I'm sure that there are people that can do it mathematically, but this is the way I'm looking at it. And at a certain point, you break down. Look what happened. Went right back into the channel. That makes the weekly chart really important. Why? Because there was a moment where we were outside, we were underneath that major support level of the channel twice. This is the second time. But you remember what I discussed earlier? I said, this is a possibility that we don't go under the 1820.66 low of the S&P, but we do pull back sharply. I'll be back.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization deviation capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Each and every time that the dollar ticks higher, S&P wants higher price. Each and every time that the dollar's ticking lower, guess what? S&P wants lower price. Dollar, the metals, and the S&P are going tick for tick.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. Basil Chapman here, and I just wanted, we're going to go to, hi, Mark. You there?
Yeah, Basil, how are you?
I'm good. Can I just hold you for 1 second? I got a question. Someone made a statement in the den, and I thought that it's really appropriate. This is a perfect time to look at it, and it might be applicable to your question, but let me just quickly show the chart because I'm liable to forget. It's what I discovered many years ago, decades ago. The approximately 7-year cycle, I actually noticed it earlier, but I made a big deal about it in 1998, where the market topped in January of 2000, and then I gave a synopsis of what I was looking at, and then the projections out of the 7-year cycle. And it's incredible because the 7-year cycle has just been an absolutely, it was actually what I called a 41 to 43-year cycle. But then I broke it down to 7-year cycles in the Dow. I'll talk about it. I would talk about it on Technical Friday, but I won't be here tomorrow, so I'll talk about it sometime next week. But most importantly, it says right here, there's although we're in bar 43, the month 43 that matches the previous Dow highs and lows. This is a little different because this one is a 7-year cycle, and it would go from the 2007 high, which comes in at 2014, but theoretically, I wanted to split the difference to make it between the low of March of 2009, and that would take you to round about 2015. In this case, we are looking at right now at the 7-year cycle almost completing, but it could in fact last a little longer. We'll see. Anyway, I just wanted to get to that. Now you've got a question. Mark, what is your question?
So I'm looking at the USO, which is interesting because it's struggling, and the market had been falling with oil, and now it's rising with oil kind of staying in this low range here. And I was looking at the 120-minute chart of the USO.
So we'll go there right now. Let me put this up here. USO is United States Oil Fund. USO, let me type that in. There it is. Whoa, struggling, yes. So can I just speak to this just for a second?
Yeah.
So what everyone was expecting, and I couldn't quite understand it, all of a sudden, it wasn't there, but then all of a sudden what people said was, watch oil, the Dow is going down, matching the price of oil. But actually, I thought to myself, and I spoke about this a little earlier, and what I said is, oil had made its high, the USO made its high at 39.44 back in June. So I think it exacerbated it, but I just don't think that there was any direct correlation. The correlation was basic nervousness and a sell signal that turned into sell mode. And now we're in an oversold condition and getting rid of it. And that's the reason why the close today, especially Friday at 4 o'clock, going into Monday, a light trading week, is going to be so important, whether or not. And I never got a chance to talk about it, so I won't talk about it right now because your question is about the USO, but I better write it down because before the end of the show, I'm going to say talk about sharp trough A. I mentioned it to my subscribers this morning, then trough, if I can read my handwriting, trough B. I hope someone reminds me at least at 10 to 12. So now let's go to the crude oil. The power of the selling, and this is what I spent quite some time yesterday talking about, was, how can I put it? Tom had spoken a little earlier about Amazon and what's happening with Amazon.com, and that they're going into Manhattan to do this 1 hour purchases of groceries or anything. And he said, I said, wow, that's like an island within an island. It's like a country within a country because of the number of people in Manhattan and because of the opportunities there and because there's a market for it. Well, think of it this way. When you're looking at oil, you're not talking about you, me, you're not talking about JP Morgan or Goldman Sachs. You're talking about countries. You're talking about China. You're talking about Russia. You're talking about the United States of America. When money gets put to work or doesn't get put to work at that velocity, and that's the reason why we have to keep in mind here that the wind that Yellen is blowing right now, we have to assess to see, is this enough to be able to push the sailboat even further ahead, or is it going into turbulent waters right now? So now let's go back to crude oils, because these are all concepts that I want to kind of try to relate to the power of a tide that has changed. And I believe that the crude oil tide has changed to the extent that the money coming out and the money that is shorting is like a super tanker, and you don't get your little sharp, the little rudder of the 120-minute chart or the runner of the daily is not going to change the weekly or the monthly until this super tanker starts a really meaningful series of bottoming processes, maybe makes an H pattern to have an internal low and then a residual low that's either higher or lower, but it's the emotional low, and then you get your turn to the upside. So that's that. Now on a shorter term trade, the reason why I never went back in, I just purely on a technical basis, I'm going to try to, if I can, I'm going to try to blow up this chart a little bit more, probably not a good term to use. I'm going to try to expand. And if you can look and you see this little red line here, if anyone's looking at my charts, there's a little red line. Just for the moment, I'm going to make it nice and thick. It's a 9-period simple moving average style. I'll make it nice and thick so it's going to cross the black line. There it is. It is only now just tucking underneath the black line, the 9-period exponential moving average, and that's suggesting that we might find that crude oil, in fact, is getting close to some kind of a bounce. And that's, I think, one of the reasons why the big guys don't have a chance at a moment's notice like you and I could just go click and we could go into position. It's not quite that simple when you're getting into that kind of situation in when countries are involved. And this is what I think is the issue. So that's the reason why I kept saying that if there is going to be a bounce in crude oil, I'm going to go to the crude oil chart right now, it really needs to show that it is able to break away from these levels in the 54, 55 area and spiral quickly, and I even drew the arch formation towards the 9-period moving average, which is way up in the 9-period moving average is at 69. So going to your question and whether or not it is worthwhile looking at the USO or any one of those any one of those crude oil ETNs that can go with crude oil, my suggestion is in the beginning it's worth just nibbling and you keep putting your stop, just a real safe thing. If it takes out 53.93 on the continuous contract, or USO takes out the low of 2 days ago, the low of 20.53, even though that could be the very moment that it turns around and goes up, I would still be having very tight stops and I'd only have small positions. But now you're getting some clarity. And what the clarity says, that if there is a price movement above the candle of 22.43, above the candle of the 17th, that would be the first time. In other words, 1 penny above 22.43, and I would nibble. That's the way I would play it. And all I would do is nibble. It might be the move that within moments, like the 2 days of E-minis right now, just powers higher. But at least you got your foot in the door, and you can increase your position if it shows the 120-minute chart shows it hasn't broken the low of 20.53 and it's starting leg C, and it should go to a D. And then the big gap down the day at 11:30 on the 10th with a high of 23.68, that area of the high 23s should be a very quick target. So it's the only way I would do it, because as I say, any move now I believe would have to be thought of initially as just some covering, number one, and then some of the big institutions or the countries starting to nibble on the upside, saying, hey, I think we can rally into mid-January. That's kind of the way I would look at it. I hope that helps you.
Yeah, I was kind of looking at it that it's formed a B in the 120s. I didn't know in the 120-minute chart, and I was wondering if you thought it would get to a D in that. And/or I also was drawing in some type of a channel, like almost like a rising axe.
Yeah, but it broke that channel. It's kind of broken it. It hasn't completely broken it. That channel, I'm using the lows that were made in the 120-minute chart, so it needs very quickly to get over 21.35.
Right.
That's the way I would look at it. So as a trade, and then you can add to it on the upside, but boy, I would have very tight stops. You don't want that overnight risk. That's all.
Okay, thank you.
Hey, good question, and we're getting close to at least the attempt of a bounce here. But as I say, the biggies are going to have to get in for it to really move in weeks rather than just days. Okay, let's go to Marvin in Orlando. Marvin, how are you?
Hi, how are you? Thank you for taking my call.
My pleasure.
I was just wondering if the Fed was meeting just interrupted the downward move? Because I thought we were going to go down to the 200-day moving average, which probably I was thinking maybe closer to the beginning of January when we get there, but I was just trying to get your insight on that.
Okay, so let me just do this. This is a really good opportunity. It's what I was going to do before, but I always love to take calls, so I'll try to relate it to this call right now from what I was saying earlier. Now, there's a pattern that I call the falling axe, and that's in the Chapman wave methodology. All it implies is that from a peak, D, E, or F, you start to make lower highs and much lower lows, and that's exactly what happened in that single leg A to the downside. And this is great because it takes me to my very next issue. So the single leg A that reverses sharply to the upside can very often power a move into a brand new buy signal to buy mode very quickly, especially if it breaks out from the falling axe. This is the pattern here, and this is the pattern that I'll be looking at from there to there, and then all you do is you go click and you get a new parallel, an equal amount, and that should take you to, if I can hit the right there, and that, oops, it didn't. That's not the one. That's the one. There. And that should take you from the breakout level. So this is almost a perfect example in the Chapman wave of a breakout that went, I've got to reverse these lines, a breakout that went exactly 1-to-1 in the Chapman wave falling axe formation in the weekly chart. Then what happens is there's a pattern that I call the double camel hump, just because it looks like, if you've ever seen a camel that has two humps, it looks like that, and it relates to the stochastic, the slow stochastic, that sometimes, and it did that in October of 2007, in that sudden spiral to the upside after everyone thought they were correct in shorting, and my work just said we were not complete, I didn't know why or how, but eventually we got to that pattern that said, okay, now we're pulling back. And that was just a very quick, it was like an A, B, which was an alternate count EF. But now what's most important is when I look at the weekly chart here, it said that if on this Friday, there was a close, this Friday or next Friday, there's a close below 1963, it'll make it really clear to me to say, oh, now we've got to be careful because that's that arch formation failure pattern. But we've held the up channel, this long-term up channel. It went right to the line, and now it's back up again. That's number one. Number two is the 9-period moving average, exponential moving average in the weekly chart of 2026. We're above that right now, and that's going to be really important. We're at 2038, up 25. So far, and we've got a day and a half to go, so far the uptrend in the weekly chart with the stochastic at 90% and the MACD looking like it wants to deflect higher, making an M-shaped pattern, says you were right in shorting on the daily because the daily was giving you all the signals, but now you have to, at least for this moment, and this moment could last until tomorrow or could last until Monday, at least for this moment, you've got to stand back and say, wait for other evidence, because the MACD is still in the daily chart, hasn't crossed, it's flattening out and slightly rising, but it hasn't crossed positively, and the stochastic is still at 17%. That's really poor action. Now I'm going to get to the other point that I want you to make, and this is very important. Hope you don't mind me going through this because it's what I want you to do in any case, number one. Number two is I think it's really important right at this phase to discuss another aspect, if you don't mind. And that is on the way down, there are times where the selling is so severe, like in October. In October, the selling was so severe, but we continued lower because it was trough A, trough B, trough C, trough D, trough E. Eventually at 1826 we turned up, made that made that crossing of the falling axe pattern, the expanding cone. But if you look at the weekly chart only made a single leg A, and then it went to new highs. So my definition of a very serious move to the upside, Mitch, there's a question in the den. I'm going to answer you as we go to this question. What's moving red, which we actually own, Rite Aid? I thought it was a takeover or something. It was fantastic earnings. So now I want to talk about what happens when you pull back and you only make a single leg to the downside and then start moving higher. So are you able to hold on?
You take a hands-on approach to managing your investments. And whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
TFNN has just announced a special sale for the Gold Report for a limited time only. To celebrate the 660th weekly issue of Tom O'Brien's Gold Report, that's more than 12 years, TFNN is having a special one-time sale. Right now, you can receive 60 weeks of the Gold Report, that's 14 months, for only $600. We're offering Tom O'Brien's dynamic weekly newsletter at only $10 a week, half off the regular monthly price. By taking advantage of this special offer, you also get a signed copy of Tom O'Brien's best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, an $88 value. The Gold Report is published every Tuesday and provides subscribers with Tom O'Brien's expert commentary on the industry, as well as detailed information on a variety of mining equities. This offer is valid for current or new subscribers, but is only good through this week and ends this Sunday, December 21st. Lock in the low rate of only $10 a week for the Gold Report by placing your order at the front page of TFNN.com today. Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. The Futures Hour, next on TFNN.
Hi, folks, we're back. So the Dow's up 246. You see, when I said to subscribers this morning, we're going to have to wait for the 2 short squeezes. From the opening, there's all that short squeezing and all that. What happens then? Then there should be a bit of a hiatus, a little pullback, and then you get the second squeeze. And this is the second squeeze right now. How we close the end of the day, how the Dow pulls back, or S&P, or the comp index pulls back, going to be really, really important. And they're all up about the same 1.5, 1.7%. And so this is going to be, today is really important going into tomorrow's close for at least to tell me whether I must even think. I'm not afraid to go short on certain stocks now, but I'm watching the indexes closely. I don't know if it's going to be worthwhile doing it at least at this particular point. So now let's go back to the weekly chart. So in the S&P, which is 500 stocks, actually a little more than 500, let's call it 500 stocks, I've had no real... there's no reason why I should not call this A, and it could fail, but I don't see. The start of this was that instant restart right on the 16th of May, the week of the 16th, with a low of 1862.36. We went down to 1820. That is a big difference, and that would, the only way I could count this as a failure pattern would be to say I've got a technique called the unconventional Chapman wave flat base restart. So let me just sum it up as clearly as I can. What's happening at this particular point is that I'm going to still keep this as peak A, at least for now. I don't really have an alternate count, and that would suggest that within the next, by going to the close on December the 31st, if at any point I would like to say it doesn't have to be a close, but I'm going to be safe. If there is a close under today's, this week's candle of 2046, let's just say a close under 2040, that would be very significant and suggest we're going to continue having a digestive phase going into early January. Now, the big question is, I've been asked by emails and everyone that I speak to, what about the long term? Well, as you know, I've not mentioned anything about getting out of everything for the long term. My belief is we are still in a mega bull market and that we will be going higher. And so far, the monthly charts have given no signal whatsoever, just a hint, but no signal as to a change of pace. And what's important is the high of 2075.76 went to 2079.47. So leg E is continuing right as we speak, so it'll be January before you can get a confirmation of a peak E. Do you have any questions? I'm not sure. I thought that Marvin was holding on. Marvin, okay, let's just say that if I'm sure he's listening somewhere, but maybe he's not able to hold on. Now, what's going to be really interesting is that we've got another potential falling axe in the daily chart, and that's going to suggest that there needs to be a close in the S&P, just as the daily chart needs to be a close above about 2051. You close above 2051, I think you're going to be forcing fund managers back into the market. So daily chart, I'm a little hesitant now. Just to, it's a daily chart. I can't give you a call on the close today. I can just say if there's a pullback by the end of the day and it falls sharply, so the S&P is only up, and instead of 2042, it's at 2032 or 2020. I'd say, okay, very suspicious. We're going to go sideways for a little bit, and then we're going to check out what the support levels are. If there's a close at the highs, and tomorrow's a doji candle, and Monday starts a higher high, I have to say that weekly chart's the most powerful thing, and that weekly chart so far has held the support. That's all I can do. I can just say to you, it's held support. It's above the 9-period moving average. Everything is looking good. And make it real simple. The VIX index. The VIX index spiraled up to 2520. It's at 17. If it pulls back sharply after this and goes under 15 to 14, this market will go higher. Marvin, if you're still there, thank you for holding on. And I'll be back on Monday. Have a great couple of days.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
This is TFNN.